So let me summarize the facts that I've covered or previewed today. We'll look at them in more detail later on. First of all, the expected return on stocks, which we call risk premium, expected return are the same words for the same thing. It's big. It's about 7% on an annual basis, and that's stocks relative to bonds. What will you say? Let's buy. No. The thing we're going to do is try to think about that as an equilibrium compensation for risk. Why didn't everybody already buy? Because they're scared of the risk in stocks. What is that risk? Well, we did look and saw that the standard deviation of stock returns is also big, 18% on an annual basis. That's not going to turn out to be our measure of risk, but it is an indication that this idea of high returns correspond to risk has some legs to it. We also noticed that stock returns are correlated with business cycles. Stocks tend to fall in bad economic times. That's a better sense of why people treat them as risky. It's terrible to wake up, it's a recession, and your stock market portfolio just fell at the same time. That makes people specially worried about stocks, and that's the essence of the theory that we're going to come up with. Second set of facts. The expected return is not only big, but the expected return or risk premium varies over time, much more than you might have thought. The standard deviation of expected returns is about 6%, almost as big as the expected return itself. Again, when you live at a time of high expected returns, a time of low prices, why doesn't everybody just go out and buy? Well, that suggests a time-varying risk premium. And the general story looks a little bit plausible. Low prices tend to be business cycles, times when people are afraid of holding risk. High prices, low expected returns, tend to be good economic times when people are more willing to take risks. Anyway, our theoretical investigation will have to take as a fact to explain big variation of risk premiums over time as well as a big risk premium itself. Third, expected returns, risk premiums vary across kinds of assets, also a lot on the same order as their magnitudes. We saw across stocks factors of 2 and 3 differences in the expected returns. Again, does that mean go buy value stocks? Well, what we're going to do with that is try to understand why that could be an equilibrium compensation for risk, why the high expected return assets are in some sense riskier than the low expected return assets. That will bring us to factor models like the capital asset pricing model, and to the question, why are the factors priced? If we say a stock has a high expected return because exposed to the value premium, well, why is the value premium big? We need to not just have these facts, understand the language people use to call explanations, and then investigate how the explanations actually work. So how do we measure risk premiums across assets and over time to explain these facts? What are the macroeconomic sources of risk that drive the premium? What are people afraid of? And why does their fear vary over time? What is this zoo? I only showed you value. There is a zoo of factors. There's 10, 20, 30 new factors that seem to provide premiums across assets. Where do those all come from? Good questions. And I hate to tell you, we don't have all the answers. What makes asset pricing so exciting is we don't have all the answers. But we do have a theoretical framework that helps us think through these things. And that's what we'll do next.